When people think about investing, they often think of stocks first. It's the most common way to own a piece of a company. But if you're new to this, it can also feel confusing or even intimidating. You might have heard amazing stories about people making millions, and you've also heard scary stories about people losing money. So what is a stock, really? How does it actually make you money in a sensible, practical way? That's exactly what we're going to cover today on Invest Easy 101. Let's clear up a big myth right away. The stories you hear about turning a tiny investment into a fortune overnight are like lottery wins. They're incredibly rare. Trying to get rich quick with stocks is more like gambling than investing. Real investing is different. It's a long-term process based on ownership, not luck. So let's start with the absolute basics. What are you actually buying? A stock, also called a share, represents a small piece of ownership in a company. When you buy a share, you become a partial owner. Think of a company being divided into millions of tiny slices. Each slice is one share. If a company has 1 million shares and you buy 10, you own 10 1/millionths of that company. It's a very small piece, but it's real ownership. Companies sell these shares to the public to raise money to grow their business, like opening new stores or developing new products. So, why would you want to own a small piece of a company? What's in it for you? There are two main ways you can potentially earn money. The first is through something called a dividend. This is when a company shares a portion of its profits with its owners, the shareholders. It's like getting a small portion of the company's earnings sent directly to you, usually every 3 months. Not all companies pay dividends, especially younger ones. The second way is through the stock's price increasing over time, which is called capital appreciation. Here's how that works. If a company is profitable and reinvests its money wisely to grow, the company becomes more valuable. If you own a piece of a more valuable company, your piece becomes more valuable too. This increase in price is how many investors build wealth over years and decades. It's important to know that not all stocks are the same. They come in different categories. Some are called growth stocks. These are shares in younger companies that are focused on expanding quickly. They often don't pay dividends as they reinvest all their profits back into the business. Their value comes from the hope that they will grow much larger in the future. Others are called value stocks. These are typically shares in larger, established companies that may grow more slowly but are often profitable and might pay steady dividends. Stocks are also grouped by where the company does business or what industry it's in, like technology, healthcare, or consumer goods. Different sectors behave differently. For instance, companies that sell essential things like utilities or healthcare might be more stable during economic downturns than companies that sell luxury items. This is why diversification, owning many different stocks across sectors, is a key strategy for managing risk. You can also invest in stocks from different parts of the world. There are US stocks, international stocks from developed countries, like those in Europe or Japan, and stocks from emerging markets, which are countries with developing economies. Emerging markets can be riskier. They might face issues like political instability, but they also offer the potential for higher growth because they are developing from a smaller base. It's a classic example of the risk-return relationship. The possibility for higher returns comes with higher risk. Now, you might remember our last video where we talked about bonds. It's useful to compare them. A bond is a loan you give to a company. They pay you interest and must pay back the loan. A stock is different. It's ownership. The company doesn't owe you your money back. There's no guaranteed payment. If the company does well, you might get dividends and see the stock price rise. If it does poorly, you could lose money. However, as an owner, your potential gains over the long term are theoretically unlimited, whereas a bond's returns are fixed by the interest rate. There's also another type of share called a preferred share. It's a bit of a hybrid between a stock and a bond. Preferred shareholders usually get a fixed dividend payment, like bond interest, and they get paid before common shareholders if the company has trouble, but they often don't get the same voting rights or potential for high growth that common shares offer. They are for investors seeking more consistent income. So, to bring it all together, a common share makes you a part owner of a company. You make money if the company shares its profits via dividends, or if the company grows and becomes more valuable, increasing the stock price. It's a way to participate directly in the success of the businesses you believe in. It's not a guaranteed ticket to wealth, and prices can go down. But historically, over long periods, owning a diversified collection of stocks has been a powerful way to build wealth. The key for a beginner is to start with a simple, low-cost strategy, like investing in index funds or ETFs that hold hundreds of stocks, instead of trying to pick single winning companies. This spreads out your risk. Remember, investing is a marathon. It's about consistent participation and patience, not timing the market or chasing hot tips. Thank you for joining me. If this breakdown helped demystify stocks for you, please consider subscribing to Invest Easy 101. We're here to make your first steps in investing clear and confident. Let us know in the comments what investment topic you'd like us to explain next.